Welcome to Chapter 5 of our Financial Statement Analysis course. Yes, I said Chapter 5, even though we have completed Chapters 1, 2, and 3. We will be completing Chapter 4. However, I deliberately changed the order to hopefully enhance your comprehension of the concepts. My hope is that after reading Chapter 5 and subsequently reading Chapter 4, you will agree with me that the sequencing that we have is in fact correct. So in Chapter 5, we are asking the major question, how are financial statements constructed? And you simply need to remember that financial statements are summaries of transactions that have already occurred. I remember sharing with a class once that when you are reading financial statements, you could actually start by saying once upon a time, not in the sense of a fairy tale, but in the sense of a historical report. So the financial statements summarize transactions and events that have already occurred. Let's begin with a look back at the first 3 chapters and some of the highlights from those chapters. Recall that we identified that general accounting focuses on transactions, whereas AFS, analyzing financial statements, focuses on the financial statements. And so it makes sense that we understand how those financial statements have been put together so that we can correctly question the statements as part of our deconstruction or analysis of the statements. Second key point is that all business sectors, we discussed that this course emphasizes 6. All of those business sectors have an operating cycle. Recall that the operating cycle is the one that begins with cash and ends with cash. All business sectors have an accounting cycle. This is the one that begins with identifying if a transaction has occurred and then ending with a complete set of financial statements. And also that each business sector has, of course, financial statements. While all business sectors have these things in common, the specific nature of each will be different. So the operating cycle has the same general parameters. However, the specific events within each is going to be different depending on the sector. Same thing for the financial statements and the accounting cycle. The specific transactions that are recorded will be different depending on the business sector, agricultural, manufacturing, retail, etc. Also, the financial statements, they will have assets in the balance sheet. However, the components, the percentage breakdown of those assets may differ depending on the business sector. The other major takeaway from the previous lessons is that business structure is going to be impacted by factors such as access to funding. So whereas you may want to run your business on its own, it may be advantageous to have a partner because then you would have access to more financing, more resources. Another factor would be, of course, managing risk and liability. If you wanted to minimize your personal exposure, you may want to have a C corporation as opposed to a sole proprietorship. And third, but certainly not least, and again, these three are not the only factors, but the primary ones would be the tax consideration. Do you want to be taxed at the corporate level, or do you want to be taxed at the individual level? There are times when one tax rate may be more advantageous than the other. The fourth major takeaway, in my opinion, has to do with funding the business. The loan type, we discussed several of them: operating line of credit, term loan, lease financing, and so on. The loan type is going to be dictated by the purpose of that particular loan. And of course, the need of the client is going to be a major consideration there. We should also ensure that the repayment source is consistent with the type of loan that is being extended. You would not want, for example, to be providing an operating line of credit and expecting or requiring repayment over several years. If it's for operations, then it should be repaid within the operating cycle of that particular business. And then equally important, the term and other structures of the loan should be considered. And so you want to make sure that the type, the purpose, the sources of repayment, and the terms of the loan, that they all be in congruence. If you do that, then you should be in a good position with regards to your customer, the client, and of course, the bank or lending entity for whom you work. Let's move on then to the focus of Chapter 5, which is understanding how financial statements are prepared or constructed. I'm about to share with you 6 basic principles that I believe will significantly enhance your understanding of how financial statements are prepared. They are derived from a book titled Accounting is Not for Dummies that is currently being written. One of those key concepts is that all transactions involve a get and a give for each of the parties involved in that transaction. For example, sale of inventory for cash, the get would be the cash, and the give would be the product that was sold. Another example would be the purchase of inventory on credit. For the purchaser, the get would be the item purchased, the inventory, and the give would be a promise to pay in the near future. Another key principle is that since each transaction has a give and a get, we can now convert that into the more familiar debits and credits. And the general rule here, which is easy to remember, is that whenever you have a get, it is always recorded as a debit. And whenever you have a give, it is always recorded as a credit. That should make it easy for you when you are trying to figure out how to record a particular transaction. Again, let's go back to the example that I used earlier, where the business sold inventory for cash of $100. We can identify the get, which is the cash of 100, and we can identify the give, which is the product valued at $100. And since we know that all the time when we have a get, we're going to debit, and every time we have a give, we're going to credit, we also then know how to record this transaction from the point of view of the seller. So if we have an account for cash, we're going to record the get because that's what we had, which would then be a debit. And the give, which would be the item that we are selling, would be our credit. So we debit cash for $100 and we credit revenue or sales for $100. Let's go to the second example, the purchase of $200 of inventory on credit. Again, we know what the get is. It is the inventory. And we know the give, which is the promise to pay the $200 in the near future. So the get is going to be debited. So we debit the inventory, which is an asset, for $200. And we credit a promise to pay, which would be accounts payable for the $200. The third key principle is that each get or debit is recorded in the left or column or account, and each give or credit is on the right, in the right column or the right side of that particular account. There really is nothing magical about the sides, except the convention in accounting is to use one side to record what we get and one side to record what we give. And so each of these debits, regardless of the transaction, will be on the left or debit side, and each credit will be on the right or credit side of the account. The impact, principle number 4, the impact of making a debit or a credit is going to be dependent on the type of account. So if you are recording a get, each time you record a get, you are going to be increasing that particular side of the account. And each time you record a give, you're increasing the credit of that particular account or the balance in that account. But the difference, which is the balance, is going to be dependent on which side is larger. We have what is called normal balance. And in accounting, when we say normal balance, we are really referring to the expected balance. And so what would you expect? Well, you would expect that if you're recording every time you get, you record that as a debit, then any account that is recording a get should have a debit balance. And any account that is recording primarily what you give is going to show a credit balance. So the normal balance is simply the expected balance for the account. And so when you look at the different categories of accounts, assets and expenses, they result from a get, right? If you buy an item, that's a get. It could be an asset if it's going to be used for an extended period of time, or it would be an expense if it's short-lived. So each time you have a get, it's going to be debited. And if you are getting something of value, asset or an expense, then it would be, the normal balance would be a debit. So with those principles, let's go through a few transactions to see exactly how we would be recording them. And the key point here is that how you record a particular transaction is dependent on the perspective. So are we recording it from the point of view of the business, or are we recording it from the point of view of the owner of that business? The default for our purposes is to look at it from the point of view of the business, not the owner of that business. So that determines how the transaction is recorded. But what gets recorded is dependent on the method of accounting that we are using. There are two major methods that are available, and then there is a third, which is really used primarily for tax purposes. Let's go through quickly the methods that are mentioned in your textbook. The first one is the cash method. And the cash method is exactly what it suggests. Transactions are recorded only when cash is involved. Either you're receiving cash or giving cash. So if the example is purchase inventory for cash, it would get recorded. If the transaction is purchase inventory on credit, that transaction would not be recognized as a transaction because it does not involve the immediate receipt or disbursement of cash, so it would not get recorded. The other method is the accrual method. And this is the method of accounting that's required under what is called Generally Accepted Accounting Principles, or GAAP for short. So if your bank requires that you get financial statements that are in conformance with or in conformity to GAAP, then they need to be using the accrual method. What exactly is that method? Well, under the accrual method, all transactions, as long as there's a give and a get, they will be recorded. Let's go back to the same two transactions. Purchase of inventory for cash, it would be recorded because there's a give and a get. The second one was the purchase of inventory on credit. There is a give and a get, so it would get recorded. So even though in the second transaction, there was no immediate disbursement of cash, it still gets recorded. So the accrual method gives us a broader perspective on what is going on in the business compared to the narrow view that the cash method would provide, because it limits itself to cash transactions. A lot of small businesses use the cash method, so it's not that there is anything wrong with it. It is simply that it's inherently limited in terms of what it records as opposed to what it should record. The income tax method is one that is used primarily for tax purposes, and so it's going to be governed by the rules of the Internal Revenue Service. Essentially, it's a modified version of the cash method where it focuses on what you actually received during a given year and what you actually spent, but then it modifies and it requires certain things or allows certain things such as depreciation to be recorded, or it limits the amount of a particular expense that you can record on your tax returns. Because of the nature of the income tax method, it can result in what is called a timing difference between what you report, say, on your financial statements versus what you have on your tax returns. For example, if you received $500,000 in 2020, however, you earned it in 2019, then in 2019, you would not have reported the $500,000 to the Internal Revenue Service because it wasn't collected. But on your financial statements, you would show that you are owed $500,000. And so there's a timing difference, and that timing difference, as you will read in your textbook, can result in a deferred tax liability, which means that the company will have to pay taxes on that income in the future, or it would result in a deferred tax asset, which essentially means that you paid too much taxes now and you may be entitled to a refund in the near future. So if your company accepts tax returns as the basis for evaluating a loan request, you would want to be aware of that particular modified version, if you will, of the cash method. So now we look at some examples to hopefully make much clearer the concepts that we have been discussing, the cash method versus the accrual method. The first transaction I have here is that in January 20X1, Tara started Tara Consulting Services, we'll refer to it as TCS for short, with $100,000 in cash, which was placed in a business bank account. And so there is an account that would have been opened at a bank, and it would be in the name of Tara Consulting Services. How would that transaction be recorded? Again, the first question would be, from whose perspective? We are going to look at it not from the point of view of Tara, but from her business, which is the consulting service. And so what did the consulting service get and what did it give? And so the answer would be, if you're using the cash method, the get would be the cash of 100,000. The give would be the claim that the owner now has against that business. In the books of the business, we would have an account for cash, and it would be debited because that's a get for the business of $100,000. And so that account now has a balance of $100 that it will show. But remember, for every get, there has to be a give. That's a fancy way of talking about the double entry system, but it's easier if we simply refer to get and give. And remember, your get should always be equal to your give. So we have a get of 100,000. That's how much the business got. And what did the business give? The business gave $100,000 equity or claim against the asset of the business equal to the amount of the investment by the owner. That's the cash method. Well, under the accrual method, there actually would be no difference because remember, the accrual method records cash transactions as well as credit transactions. So in both sets of books, the entries would be exactly the same. The debit to cash for the get of 100,000 and the credit to capital for the give of $100,000. Again, notice that my get or debit is equal to my give or credit of $100,000. Let's look at another transaction. This time, we have the business paying a total of $15,000 in cash for supplies and using $12,000 of that total before the end or by the end of the fiscal year. What would happen in the cash method? Well, in the books, if the business used the cash method, cash was involved, and so they would record the entire $15,000 because that's the amount of the cash. So we would have an account for supplies. We would record a get of $15,000, and we would record a give also of $15,000. Notice that this give is impacting negatively the balance in the cash account. So this is an asset, right? Money that's owned by the business. But by giving 15, we have decreased the balance in the account by the $15,000. So we're now down from 100,000 to 85,000. So this asset account cash was initiated with a get, but the impact of a give in the same account is a decrease. So if we added all of the give recorded in the cash account, we would then subtract or deduct from the total of the get, and that would give us the net balance in that particular account. How would that transaction be recorded under the accrual method? Interesting difference. First of all, cash was involved, so the entry for cash would be the same as under the cash method. However, remember we were told that all of the supplies had not been used. It says 12,000 of the total was used by the end of the year. So they still have $3,000 of supplies on hand, as in available to be used in the next period. And so what we needed to do, which would not be allowed for under the cash method, is we need to take $3,000 out of the supplies expense where it was originally recorded and place that into an account for supplies. And so with that entry, we are now showing that our expense for supplies would be $12,000 because that's the amount that we actually used during the year, and we would have $3,000 now as an asset to bring forward to the next year. Our third transaction involves TCS providing $75,000 in consulting services for the year, and they received $50,000 cash before year end. Again, the cash method sees the 50,000, not the 75. And so there would be a record for the 50,000. Cash would be debited because that's a get of 50,000, which increases our cash balance from 85 to 135. And of course, there would be a give, which is the service of $50,000. So under the cash method, they are saying that revenue for the business was 50,000 because it's limited to what was actually collected. What about the accrual method? What would they do differently? Well, clearly they're going to record the entry for the cash received. But notice that they're also going to show that they have $25,000 to be collected, to be received. So it's a receivable of 25. And therefore, their total revenue would not be limited to the $50,000 of cash, but would actually be $75,000 because that's what they earned. They provided the service, so the firm has earned 75, but they still have $25,000 to be collected, to be received. So it's a receivable. And so we are going to bring that $25,000 over into the next year to show that we still are expecting a cash inflow of $25,000. Let's take example D. What happened in this case? Well, Tara Consulting Services, they purchased office equipment for $27,000, which with a down payment of $7,000. And you can tell what's going to happen here with the cash method. All the cash method sees is $7,000. And so that's what's going to be recorded. $7,000 would be the give, and the office equipment would be the get for $7,000. And so you can record the reduction, $7,000 in cash, and it brings your cash down to 128. And of course, the office equipment would show $7,000. What is wrong with this? Well, under the cash method, the answer is nothing. But under the accrual method, the picture is viewed differently. What the accrual method sees is that the business received an asset, the get of not $7,000, but $27,000. And so it's going to record a get for the 27, and it's going to record a give for the 27, but then part of that is going to be reduced by the $7,000 cash. So notice that the difference here is we are showing a promise to pay, and it says note payable as opposed to accounts payable because we would have actually signed a promise. So one would be verbal, accounts payable, represented simply by an invoice that we would have received from the seller. Whereas here, the seller wants us to sign, indicating that we are going to be paying. And usually this happens if the repayment is going to occur over more than a year. In any case, we have a payable for 20,000, right? Because we bought it for 27, but we paid down 7. So the claim from the seller is for the remaining $20,000 that is to be paid. And notice that the equipment is now reported on the books not at $7,000, but at $27,000. So we're getting the sense that the picture that is painted under the cash method is different from the picture painted under the accrual method if there are transactions that involve either the delay in paying cash or a delay in receiving cash. And so if you were to receive financial statements prepared using the cash method, be fully aware of the limitations of that information. You're going to have to ask questions about things that they owe or amounts that are owed to them because the financials would not reflect that. So now we get to the point where we summarize. And one of the first statements that we use to summarize what has happened in a business is called the income statement. This financial statement summarizes the financial performance of a business or any other entity over a specified period. In this case, we're looking at 1 year. And you can tell that the date is going to be written the way it is because the income statement captures a period, not a point in time, but a period. And so we're saying over what period did you earn X amount of dollars? Over what period did you incur your expenses? And so the date is going to reflect the period. Notice also that the financial statement should always answer 3 questions in the title or heading: who, what, and when. And so the who would be the name of the entity. In this case, Tara Consulting Services is the name of the business. The what is the name of the report. This is the income statement, or P&L, as some people would call it. And the when would be the date. And so this would be for the year. If it were for a month or a quarter, we would specify accordingly. But this is for the year, and so it needs to indicate what period. So whenever you get a report from your clients, be sure that that information has been included. If it's properly prepared, it should. The name of the report, the name of the entity, and the date. So we have our revenue. Remember, under the cash method, they only show the cash of $50,000 from transaction C, and then they had supplies expense. They recorded the entire $15,000 as an expense. Why? Because that's the amount of the cash that was paid. So they paid $15,000 for supplies. So they recorded the entire amount, even though they still have supplies on hand. So you could argue that their supplies expense is overstated. However, that is the nature of the cash method. So when you subtract the cash expense from the cash received, we have excess cash of $35,000. You will notice I hesitated to call it net income because we tend to reserve that for the traditional accrual method. So how would the income statement be different for the firm? The same transactions, but they use the accrual method. Notice if you compare revenue with revenue, under the accrual method, the revenue is $75,000 because that's the amount earned during the year. We subtract the expenses, not 15 for supplies, but 12,000. Why? Because they did not use all of the supplies during the year. So we want to be sure we're matching expenses for that period with the revenue earned in the same period. And so, yes, the net income is different. It's $63,000 here versus $35,000. Does this mean that the cash method is going to give you a more favorable performance? In some cases, the answer would be yes, as evidenced by the income statement we have here. However, it does not always follow that one method is going to be giving you a more favorable or less favorable financial performance. In this case, it is, but it shouldn't be a conclusion that the cash method will always give us a more favorable picture or a less favorable picture. So the accrual method is showing that the net income is $63,000, whereas the cash method is showing that it is $35,000. Just to go back quickly to the point I made earlier about deferred tax liability, let's assume that the cash method reflects the income tax method. So they would be saying their taxable income is $35,000, but on their financial statement, they're saying that their taxable income is $63,000. Well, you can tell from here that the tax liability, the amount they have to pay to the IRS for 20X1 would be less. But on the balance sheet, they're going to be showing that they owe an additional amount that will be paid in the future. We'll come back to this in a subsequent slide. Let's continue then with the other major financial statement, which is the balance sheet. Remember, the income statement tells us the financial performance over a period. In this case, we're looking at a year. The balance sheet, though, tells us about the financial position. How much do you own? How much do you owe? What is the claim that the owner now has against the assets of the business? So point in time, it's like if you're using your phone to take a snapshot, this would be your still photo, the balance sheet. The income statement would be as though you were taking a video. And so whatever is happening over the period of time you are running that video, that's what would be captured. But the balance sheet would be your snapshot. So what we are showing here are the assets, the liabilities, and the equity. Excuse me. And so we have assets, cash of $128,000, which is coming from the cash account based on the transactions that were recorded. And the office equipment of $7,000 based on transaction D. So total assets under the cash method, $135,000. And look at this. The cash method is indicating that this company does not owe anything to an outside entity. It says liabilities, zero. So this would be the claim that the owner has against the assets of the business, right? The beginning amount of 100,000 plus the profit or excess cash of 35. So we have 135. Is that an accurate picture under the cash method? Yes. However, in terms of future obligations, cash needs, or future cash coming in, this is not giving us that information. And if you're looking to lend money to an entity, you want to know that. What are your current obligations? Who do you owe? What cash inflow are you anticipating? And when? The cash method is not going to give us that information. We would have to be probing and asking the right questions in order to get to it. But here, the accrual method says, same thing. The date is going to be on a specific day, in this case, the last day of the fiscal year, and the name of the report, and of course, the name of the entity. The assets are here. Cash is going to be the same, right? Because the cash inflow and cash outflow were accurately recorded in both cases. So there is no difference in terms of what the cash account is going to show you under one method versus the other. The differences will arise from transactions that involve credit. So here, accounts receivable. This business actually expects to receive $25,000 in the near future, if all goes well. In addition, if we jump down to the liabilities, they are expected to be paying out $20,000 in the near future or over some period of time. So we're getting a slightly different, some would say significantly different picture of the business based on the accrual method. Again, the office equipment, not $7,000, which is what was the deposit or down payment, but $27,000, which was the purchase price for that particular asset. And so knowing how the financial transactions were recorded will help us to better understand the financial statements. And the same thing goes, by the way, for the supplies. Notice that this account, this method, the cash method, is saying we have no supplies on hand or remaining, but we do because we did not use all of the supplies. And so we have additional things that are being reflected under the accrual method that would not show up under the cash method. So what we can say is, from our perspective as prospective lenders, we would want to use the accrual method or require the financial statements prepared using the accrual method as opposed to the cash method. What we have now is the last of the three major financial statements, which is the statement of cash flow. And this financial report summarizes cash that came in or funding sources and cash that went out or uses of cash. The cash method is easy to understand because under the cash method, the statement of cash flow is literally a summary of your cash account, okay? Because recall that we had $128,000 in cash that was on hand at the end of the year. So the question is, where did the cash come from and how did we end up with $128,000. So under the cash method, we take the excess cash from the income statement, which was, as you recall, $35,000. We take the cash receipts, subtract the cash disbursements, and we have our $35,000 here. And then we know that we spent $7,000 to purchase a piece of equipment, and we also received $100,000 from the owner of the business. And so we have our net cash inflow from operations. We have our cash that was used for investing activities and our cash that was used for financing activities. We end up with $128,000. Let me go over to the accrual method though, because this is what, as I said, you should expect or require from your customers or clients. And so it's good that we spend a little bit of time making sure that we understand exactly what the report contains. Like the other two reports, we are summarizing. What are we summarizing? We're summarizing sources of cash and uses of cash. There are three categories, if you will, to the statement of cash flow. One section, the first one, which is the operating activities, it tells us how much cash came in, how much cash went out based on your operations. Then we have the investing activity section, which tells us how much cash came in or went out for investments. Specifically, what fixed assets did you purchase, which would be a use of cash, or what fixed asset did you sell, which would be a source of cash. And so here we have the third section, which is the financing activity, which says, did you borrow any money, as in from a financial institution, or did the owner invest any money in the business? The answer to the first is no. The answer to the second is yes. The owner did invest $100,000, but this firm at this point has not borrowed any money from a bank. Maybe that's what they're going to be doing when they submit these financials to your bank. So we are showing the net income from the income statement. We are showing that there was an increase in accounts receivable compared to the beginning of the year. Why is this reported as a negative though? Well, think about it this way. If you sold a product, or in this case, a service to a client, and they did not pay you, it means that you are funding that transaction. And so this would be considered as a use of funds by your business. It's as though you are actually using your money to facilitate the transaction. Same thing is true for the supplies. And so as a general rule, any increase in assets other than cash are considered to be use of funds. And then we come down to our investing activities. Again, either we are buying fixed assets or selling. We purchased, and so that's a use of the funds, so $27,000. Did we actually spend $27,000? That is the amount of the purchase, and so we're showing the full amount. And then we have our inflow from the owner of $100,000. And you can see that the net is going to be $20,000 more than when we started. And so we end up with $128,000. I just showed you the indirect method. Now we need to look at another method of preparing the statement of cash flow, which is called the direct method. This method
shows you not changes in assets and liabilities, but the actual amounts that were received or paid out to the different entities. And so for the direct method, we start with the operating activity just like we do under the indirect method. But notice instead of starting with net income, we start with cash received from customers. Where did this number come from? Well, we look at what was sold to our customers and ask, did we collect all of that? The answer is no. Well, how much was owed at the beginning of the period? In this case, the answer is 0. And then we subtract what is still to be collected. And so the beginning balance plus the sale minus the ending balance is going to give us the cash that we actually received. And if you go back and look at the transactions, you will see that that is the case. But as far as how it's calculated, you take your beginning receivables, add the sales, right? Because if you sell to your customers, you're going to add to how much they owe you. And then you subtract what they still owe. And that will tell you how much cash was actually received during the period. And then you have your cash paid for expenses. We paid $15,000, which was the $12,000 for the supplies and then the $3,000 for the other item. And so we have a total of $15,000. Investing activities. Oh, before I get on to that, let me just quickly point out, you will get the same result for the cash from operations under either method. So whether it's the direct or indirect, the cash from operations will be the same. How you get to the number, though, is going to be different. And you can see from here, everything follows pretty much the same way. And so we end up with our cash balance of $128,000. So the indirect method and the direct method will not give you different subtotals. The subtotals will be the same. The key difference between the two is that the indirect method begins with net income or net loss. So if you get a set of financials from your customer or your client, and you see the first line item in the statement of cash flow being net income or net loss, you will know immediately that you are looking at financial statements prepared using the indirect method. If it begins with cash received from customers, then it is, in fact, the direct or direct method. This is just another example of a statement of cash flow. Notice, as I said earlier, the same 3 sections are there. The first one is cash from operating activities. And I decided to share this with you because remember in a previous chapter, we talked about the life cycle of a business. Well, during the early stage, the startup stage, and even in the growth phase, it's not unusual for cash from operations to be a negative number, okay? So if you are looking at a company that is growing rapidly, it's very possible that cash from operations will be negative. In other words, their cash outflow or use of funds will be larger than their cash inflow or source of funds. That's normal. But if you are in the mature stage and definitely in the declining stage, this should be a positive number. Not only should it be positive, it should be sufficient to fund the other 2 categories. But at a minimum, it should be positive. When we get to a later chapter in which we discuss the statements of cash flow in greater detail, we will certainly come back to this discussion. The second section is the investing activities. This is where they have cash inflow. In this case, notice they had a cash inflow proceeds from the sale of land, and they had an outflow because they purchased an equipment. So activities, inflow and outflow relating to fixed assets will be in section 2. The third section is the financing activities, and this is where they are getting financing either from the owner or from a lending institution. So if you loaned money to your client and it's still outstanding, it should be showing up in this section, right? As well as on the balance sheet. But for this particular period, we are saying that they paid out $10,000 principal on a loan. And you can see where they issued commercial common stock. So this is most likely a C corporation. And then they had payment of dividends. So their net was an inflow of $34,560. So we add 1, 2, 3, and we get an overall change in cash of $24,200, which is then added to the beginning balance of cash, and we end up with $47,500. So you can do a quick check of the statement of cash flow, and the number that they show as the ending cash must match the cash and equivalent that they show on the balance sheet that corresponds with the statement of cash flow. The other reason I share this statement of cash flow with you is notice that they have an additional line item here. This is for non-cash activities. In this case, they exchange one item for another. So instead of having any cash involved, most likely there's a note payable, and what they did was they exchanged it for land. So instead of having cash, they simply switched out one for the other. So it's a non-cash, but it's significant, and so it would be reported as part of the statement of cash flows. So right back to where we started, we had transactions. We went through each of them based on these 4 transactions. And of course, we could have so many more transactions, but I just wanted to emphasize the get and the give, the debit and the credit, and how they flow into the various financial statements and are summarized. But from these transactions, we were able to generate our 3 major financial statements. The income statement, which summarizes the financial performance of the business over a specified period. The balance sheet that shows the financial position at a specific time or date. And the statement of cash flow, which is dependent on these 2 financial summaries to be prepared. As usual, we end with a couple questions. First one says, which of the following statements is correct regarding the cash method and the accrual method? The first one says the cash method will most likely show a better financial position compared to that shown by the accrual method. Based on the example that we went through, you can tell that that would not be the case, or not necessarily the case. The second one says that the accrual method will likely show a more favorable financial position compared to the cash method. Again, that's not necessarily the case. You can have one showing favorable this time and then unfavorable the next time. It just depends on the sequencing of the transactions. The third one says the cash method will do a better job of showing the cash needs of the firm compared to the accrual method. And this, of course, is incorrect because the cash method is not going to show future cash inflow or future cash outflow. The accrual method would do that. The cash method will show the same cash balance as the accrual method. And we finally come across an answer that is correct. Regardless of the method used, the balance in the cash account will be the same. Finally, and I know this has been lengthy, but I hope it's going to prove to be beneficial. Which of the listed financial reports will best show the financial position of a business at a specific date? I hope that without seeing what the answers are, the possible answers are, you already know, because there are keywords: financial position as opposed to financial performance, specific date as opposed to period. And so it cannot be the income statement. It cannot be the statement of cash flow. And so the only one that's left would be the balance sheet, right? That is the financial report that summarizes the financial position. How much do you own? What do you owe to an outside entity, and how much is owed to the owner on a specific date? That is the balance sheet. The statement of cash flow is over a period, quarter, month, year. Income statement, the same thing. The trial balance is also on a specific date, but it doesn't show the financial position. The trial balance, as you know, is just a listing of all the balances in a company's books. All the get will be debits, all the give will be credits, and total get should be equal to total give. So the correct answer there would be the balance sheet. Please reach out to me if you have any questions regarding what was shared with you in this video.